Hello again, and welcome back to Perfect Spiral Capital. My name is Luke Tatum, and I am so glad that you are here choosing to level up your financial education once again. Today, I want to talk about policy loans, and we're talking, of course, about loaning from a life insurance company with which you have a policy. Now, is that really the right name? Should it really be called a policy loan? Is it really a loan at all? Some of these questions, there's a lot of answers, a lot of wrong answers out there. So if this has ever been a point of confusion for you, stay tuned. I'm going to get into it. First of all, yes, it is a loan. Yes, it has an interest rate. Yes, you should repay it. However, it is not the loans that people are familiar with, really, in almost any way. Now, if you go to the bank and you request a loan to renovate your kitchen, then they're going to check your income. They're going to ask for several pieces of information and do a lot of verification, and they're going to tell you what the interest rate is, and they're going to tell you what your minimum payment is, and there's going to be conditions on what would happen if you don't make your payments on time, etc., etc. It's sometimes a very lengthy approval process, what they call loan underwriting. But a policy loan is a little different. We work with mutually owned insurance companies, and that means that as a policy holder, I also partially own the company. And specified in the insurance contract itself, when I applied and got, through underwriting and I signed my final policy paperwork that says, here is your policy, please sign here. That's a legal document. And it's also what's called a unilateral contract, meaning one-sided, unilateral, one-sided. And it's one-sided in my favor. The insurance company has very few rights. They have a lot of obligations when it comes to that contract. One of those obligations is that they must provide policy loans to the policyholder, the policy owner. That's me or you if you have a policy. And it's going to specify what the conditions are, how quickly they must provide the funds, etc., etc. But this is creating a loan relationship. Honestly, though, it's treated more similar to a line of credit. Your outstanding policy loans on most insurance company websites are all aggregated together. It's not, oh, you took this loan for this, and here's a repayment schedule, and you took a second loan for a car, and that has this repayment schedule and whatnot. No. It's just how much total do you have out right now? And that amount is going to have an interest rate attached to it, and it's going to accrue interest that should be repaid over time. However, there is not a fixed repayment schedule. And if you skip a payment, since there's not a fixed schedule, it doesn't matter. This is what's called an unstructured loan. Now, it is a collateralized loan. Collateral is the thing that is tied to the loan. So in a car loan, if you don't make your payments, they're going to take your car. They're going to repossess the asset on which the loan is based. That's the collateral. Well, the collateral on a life insurance policy loan is the policy. If you have $700,000 of cash value in your life insurance policy and you take a $1,000 policy loan and then you don't make a payment, that doesn't mean your policy gets canceled. They're not going to repossess the policy. The policy, what is that? Well, it's an obligation to pay a specified sum of money at a point in the future. So if you have $700,000 of cash value, your policy is probably $1 million or more of death benefit, which means that when the insured person passes away, whether that's you or someone else, when that person passes away or reaches the age of 121 years old, that insurance company must, by contract, they must pay the death benefit, $1.2 million or whatever it is. And so if you have a loan outstanding, it doesn't matter. They just say, okay, what's 1.2 million minus the current loan balance? Well, that amount is still payable to your beneficiary, whoever is named in the contract at that time. It's very straightforward. And so what does that mean? Well, it means they don't have recouping costs. It's not a house. They don't have to foreclose and kick you out of the house and try to market it and hire a real estate agent to go, you know, list it on the MLS and, things like that. None of that is involved. It's just total death benefit minus outstanding loans equals remaining payment. Nobody even has to do that. It's automatic. It's just a quick subtraction problem. So there's not a huge unknown cost associated, which is one of the reasons that they're so flexible. But the policy loan itself, again, it's more like a line of credit. If you have a mortgage and it's a 30-year mortgage at 6 or 7%, well, you're probably paying 70+% of each payment in the first year to interest. You're paying interest first. You're paying the bank for the privilege of getting the house first. And you're paying them a lot of money. If you look at something like that, and I've got loan calculators that I use with clients a lot, but if you look at something like that, you're going to see that, oh, it's a $450,000 house, but if you keep that loan to term, and if you make all those payments over that fixed schedule that they're going to give you and you're going to sign in order to close on the house, you're going to pay like $1 million. It's not 450,000. And it's not 6% of the payments going to interest. It's, again, 70 something percent probably in the first year, depending on the specifics of what's going on. That's a lot of money. And so you're building equity in that house very slowly, even though you're shelling out huge amounts of money. And what happens if you don't pay? Well, they're going to take your house. It's not the best deal in the world, right? Same thing with car loans, etc. Even home improvement loans. There's a lot of issues with that. The longer you finance it for, the more you're going to be paying in interest. And so policy loans are not like that. Policy loans, you request the loan, they must give it to you, they give it to you. If you request $10,000, your loan balance starts at $10,000. Every day, a little bit of interest accrues. Let's say it's a 5% loan rate, which is historically very close to what it has been. 5%. Okay, so if you take out $1,000 and you don't make a single payment for the whole year, it's going to accrue $50 in interest, which is 5% of $1,000. Simple interest every day. What's the principal balance? Okay, here's 1/365th of the interest rate added on top. A few cents a day, $1.30 a day, something like that, right? And then over time, it's going to build up. On your policy anniversary, they're going to say, okay, you've accrued $36 in interest so far. $36 moves over to the principal side. It becomes principal. It's no longer in the interest column. And now they're going to start calculating. Again, let's say you've made no payments. $1,036 times 1/365th of the interest rate, 5%, every day. And so it's going to keep climbing up. Now, if you ignore that for a long, long time, that debt is going to balloon. It's going to get bigger and bigger and bigger. It's not a balloon payment. It's not what I'm talking about, but it's going to get bigger. It's going to inflate because you're ignoring it. And so that is the sense in which, yes, you should make repayments on your policy loans. You want to control the rate at which the loan balance gets bigger and bigger. It is possible to eventually have your loan balance exceed the cash value of your policy. Remember, the cash value is the collateral. Excuse me, the death benefit is the collateral on the loan. And so if the loan balance exceeds the death benefit, that's called an overloan. Your policy will be canceled. And that is not something you want to happen. I won't go into a lot of detail. But the solution to that is to make payments on your policy loans. on your policy line of credit. It's just like a credit card. You don't want to let that get out of control, right? But having it is very valuable because it allows you to instantly pay cash for all kinds of things. So if you have a $1,000 balance and the interest rate is 5%, like we talked about, if you make one payment on that, you have reduced the principal on the loan. It's no longer $1,000. I'm going to make the math really easy. I'm going to make a $500 payment on my $1,000 loan. So now the principal drops $500. Every dollar of your repayment goes to principal first. So you had a $1,000 policy loan. Now you have a $500 policy loan. Two really cool things happen right now. Number one, that $500 in about 2 weeks' time becomes available again. You can take the same amount again. It's more like a line of credit than a loan, right? You can tap right back into that pool of assets that you have, which, by the way, is going up in value every single day, every day that you live. You can use it again. And then you can pay it back, and then you can use it again. And they can't tell you no. They're contractually obligated to give it to you every time. It has nothing to do with your credit score. It's wonderful. But it's available, right? That's awesome. The other thing that's going to happen is that now there's only $500 in principal, which means that the daily interest is being calculated on $500, not $1,000. And so let's just say you get a $1,000 loan. 6 months later, you make a $500 payment. Well, for the next 6 months, you're paying interest on $500. What does that mean? Well, it means your annual interest rate is not 5%, right? Your effective interest rate on that loan is not 5% because you just halved the principal. Your effective interest rate is significantly lower than 5%. If you're making any payments at all on your policy loans, you're lowering your effective interest rate. So even if you have a situation where you think, oh my gosh, 5% is a lot, I have a loan out at 3%. Okay, but it's not 5% if you make payments. And in the same way, in the inverse way, your mortgage is not 3%. You're paying a whole heck of a lot of money, way more than 3%, every single time you make a payment to interest. So in what real way is the interest rate on your mortgage 3% in practice? You with me? Okay. So is policy loan the best word to use? Well, it's the word that is in contracts. It's what's understood. Yes, you should use the term policy loan, but it's really more like a line of credit. And because you can redeploy that, and because nobody can tell you no, and because it's not tied to your credit score, and because accessing it doesn't affect your credit score, and because you have total control over repayment schedule, this is flexibility, options, control on steroids. It gives you so much leverage to do so many things. And that is why it's called the infinite banking concept, because there are an infinite number of ways that you can utilize this idea. If you are in control, if you are your own banker, you can do pretty much anything you want. And that's the power of the ideas in becoming your own banker. So if you'd like to learn more about this or about anything else, even slightly related to infinite banking, go to perfectspiralcapital.com, check out my book, which is $1. Check out our free course, which is 11 videos long on the infinite banking concept, and book a meeting. Say hi. We'd love to talk to you. Thanks so much. I'll see you in the next video.